absolutely right. Starting with the S&P earnings, which is impossible to forecast bottom up, but even with corporations, what you have to look at is some sort of a normalized earning, and then we've adjusted downward to give us a margin of safety. But let me make this point. It was a lot easier buying them off the bottom the week of March 23rd and April 1st. A lot of the companies that I put on my list for you have already had substantial moves, so I want to point out that caveat.
All right, and Scott, maybe we'll get to some of those specific names in just a moment, but before we do, what are some of the other key kind of broad factors, criteria that you have been looking for in the last couple of months that has led you to some of those choices? What type of companies, what type of characteristics are the right things to be buying at the moment?
Firstly, you want companies with leadership positions within their respective sector. Secondly, we like companies that generate tons of free cash. In many cases, they generate more than dollar for dollar net income into free cash, so that you pretty much have a bulletproof balance sheet. And then, even though we used lower estimates, we still bought them between 8, 9, and maybe 13.5 times diminished earnings per share. We weren't out chasing high flyers. I mean, Amazon and Microsoft are great companies, but we still, as a value player, can't make the excuse to go out and buy those.
So I'm looking at the list here, Scott. I see Medtronic, Merck, Novartis, Quest Diagnostics, healthcare is a big theme. Is that because some of those companies are on the front lines and fighting this pandemic, or is it something longer term?
No, you're exactly right, but they're good businesses to begin with. Going into this, we had already owned AbbVie and LabCorp and Bristol-Myers, but we've added because the stocks got cemented pretty hard. For example, Medtronic, on the stock now is over 100. We bought that around 90. Look, beside the fact that they've got the ventilator business, they're really strong in pacemaking. They invented the pacemaker, what they call cardiac rhythm. The other ones are all broad-based, like Novartis. It's a great company. They're great in oncology, but they're great in other things. They have a new drug called Entresto, which is $1 billion-plus drug, and they have another one called Mayzent for multiple sclerosis, which is $1 billion-plus drug. So they have a broad portfolio. Same with Merck. You have Keytruda, and obviously DGX, which is Quest, like LabCorp, is going to benefit from all the testing that's going to come. And we bought that stock at around $82. We had about $6 plus in earning power to 12 PE. The stock has run back up. But obviously, they're even bigger than LabCorp in diagnostic testing. But the two of them really have dominant shares. And one of the things everybody said on TV is we need more testing before we can open this economy.
And Scott, I guess a lot of people can understand why you've picked some of those names. Indeed, healthcare is one of the best, if not the best, performing sector year to date. What about any names you've picked out that have sat within the worst performing sectors, perhaps the likes of the financials or any other sectors like that?
Okay, so in the financials, there were two companies that never sold at RPE. They got hammered. One is BlackRock, Larry Fink's company. The stock got down to about 422. It's rallied back up, but they have a dominant share, as you well know, in ETFs. The other one is Blackstone Group, Steve Schwartzman's company. The stock had come off from a high of 65. We bought it in the mid-40s. I mean, they're probably the best private equity firm in the world, but as you well know, they're really a real estate firm with very little exposure to retail. So, it's a sound company, and it was a good opportunity. Plus, I think the stock has it has about a 5% yield. I know they could cut the dividend, but it's a powerhouse type of company in the financial service space.